Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to do a bunch of different technical analysis. I'm going to give you some background information behind the technical analysis. It's more of a, it's kind of a training session, I guess. I do these a lot on the website too, training sessions for technical analysis, and we get into other stuff, but I really wanted to kind of look at the current market conditions, technical analysis, stuff like that, and maybe compare it to some other previous bull markets as well. And that the way that I view technical analysis is a little bit different than I think other people view it. And I'm going to describe why that is. So what a lot of people do is they take technical analysis, they look at the patterns, and they solely focus on the pattern itself. What is this pattern? Is it technically this? Do we have a perfect whatever? And as you do it longer and longer and longer, at least from my perspective, is the patterns don't matter as much as what maybe someone who doesn't understand the background. So what I became is I became a hybrid. A hybrid is a fundamental slash technical analysis view on the markets. I'm not solely technical analysis, although technical analysis has its merits. I'm not solely fundamentals, and I think fundamentals have its merits. What I really wanted to get into is I wanted to dive into the root cause of the markets. I want to know what drives behind these patterns. So these patterns are created by humans interacting with each other. It is basically the herd interacting with each other, creating these patterns. Now, the patterns don't create themselves out of nowhere. There's a rhyme, there's a reason behind each and every one of these patterns. And when you look at it, you're like, okay, it's patterns and it's humans trading with each other. Okay, so why are humans trading in such a manner during certain periods of time? That is the question you should be asking yourself. That is root cause analysis that I have done through engineering. You've got conditions and you've got actions. And it's called Apollo root cause analysis. You can even look it up on the internet if you'd like. And what I want to do is I want to figure out, why are we creating these patterns? So you've got certain conditions where humans behave certain ways. What we experienced here this past, I don't know, week or two, is humans are afraid. There's a lot of fear in the market. We're seeing massive gyrations in interest rates. Yields are going all over the place. That creates havoc on pricing assets. And that's why assets are going all over the place. I'm sure there's also some other things sprinkled in there. Perhaps it's these regional banks. Maybe they have to raise liquidity and they're just selling everything they can to raise liquidity. Maybe not. Maybe that's not the reason. Maybe just a straight fear trade. This cycle or this time frame, I should say, right now, is fear of banks closing and a contagion with it. And that can spread throughout the banking system, depending on the intricacies. And I don't know all of those intricacies in the banking system. I don't know them. I didn't study that. But there's a lot of fear in the markets. It's probably going to last a few weeks or something like that, however long it lasts. But I don't think it's something where we're going to get like a 1929 style crash. I don't think it's going to be 2008 style crash. I don't think any of these crashes. And maybe it eventually ends up being that later on. But I just don't have that feeling in the near term. Why don't I have that feeling? Because we don't have a housing market that's crashing. Housing market crashings is what leads to these collapses. 1929 collapse, 1980s collapse. And I don't think it was necessarily from interest rates. I think it was from the demographic running out and really poor lending practices. It happened in the 1920s, mid to late 1920s, very, very poor lending practices, just like the mid 2000s. And that was destruction of credit, deflation. I don't think that's the same setup as we have today. So what I'm going to do is I'm just going to look at the technical analysis. I'm going to see how humans are reacting. And I'm going to make a little, some comments behind this. And hopefully it gets you guys a little more comfortable, investing and looking at charts and stuff like that. So I'm going to take this off. The first thing is, these are candlesticks. I'll go through here. It's where price exchanges hands, or stocks exchanges hands at certain prices. The more a stock exchanges hands at a certain price, the higher the volume. The more resistance or support at that price that you get. So when you look at this chart, we're looking for high volume, not just volume, but places where the stock has traded hands a lot. That's where your support and resistance levels are at. So if I were to just look at this, I see a big chunk of the majority of trading that's happened in that square. We've gone back and forth in this square a bunch. You can see we've traded a lot of shares through here, through here, through here. We came up, we went above. There's a lot of shares traded at this top, a lot of shares traded inside of it. There's just a whole bunch of trading in this large consolidation range. What that means is that it's hard to get through it going up, and it's hard to go back down below it. So it's a zone where people behind the pattern are saying, you know, I bought this stock and I bought it at $26 or $27. Now the stock is roughly back to where I bought it. I'm going to add in more. Oh, I'm going to add in more too. And then that's the type of mentality that people have when you hit a support level. Resistance levels are levels where maybe someone bought it, they're not happy. Maybe they bought like at the top over here. And when the stock comes back up towards this, section up here, it wants to sell off. I'm going to sell my shares. It finally came back and it sells off. I'm going to sell my shares close enough. Who cares? And then you get this sell off like that. And when you get a lot of fear in the market, you can get a lot of selling pressure that happens in a short period of time. Kind of a end of trend washout type sale. Now, we don't know what the cause of that may be. We don't know how far it may go. We don't know any of those things. And yeah, there's a lot of people, you could put a Fibonacci retracement, and this is the fib retracement if you want to put it on here for this entire thing. And you can see that we're around the 0.5 mark. Maybe we go all the way to the 0.618. It highly depends on how large the companies are, how small they are, how volatile they are, what sectors they're in. But a lot of the times we get a pullback, 0.618, 0.5, 0.786 if you're a smaller mid-cap type company. But what matters is the conditions that the people are trading under. They are creating this pattern. So what can we discern from this? We printed a bunch of money and we had large inflation back here. So we printed a bunch of money. It was coming through the system and it was inflationary. So we went up during this inflationary time. We peaked out right here. And this is kind of where oil peaked out sometime in, I think it was June of 2021 or so. And then everything kind of like fell back down because people perhaps were shifting money in the markets a little bit different. So we were consolidating. So this up move is an inflationary move in the markets. What that means is that the inflation was gaining steam during that time frame. In 2021, they slammed on the brakes with oil, and they really raised rates quickly through this time frame, and they slammed everything kind of the brakes on. That's what this consolidation period is. And we're going through this consolidation period, and what we're waiting for is we're waiting basically for a reflation trade, for something in the market to kind of break or have problems, and then they have to reflate or expand the credit supply in the system. Now, there's a couple of things that credit comes from. And when I found this out, I thought it was pretty cool because you could basically tell when things would take off and whatnot. But there's a couple of things that are going to drive credit expansion and are going to drive this type of move higher where we have an increasing inflationary environment. Those things are, one, if we have a problem in the banking system, they're going to reflate the entire economy or banking system. They need to reliquify the system, so to speak, if there is a problem. Two, deficit spending. Deficit spending, when it gets large enough, becomes inflationary because you are printing money to cover the difference of that deficit. That's another contributor. And then the largest contributor that I found in history was real estate loaning. So that's loaning into the system from real estate, and those new loans are creating money in the system. and it's circulating through that system. And generally, the people in that demographic also spend more, so the velocity of money kicks up because they have kids. It's basically the whole max spending of their life, of their age in their life. So right now, we have that fear in the market. We're in this consolidation phase. The fundamentals are still good for inflation to occur. I've looked at a whole bunch of different information on the real estate market. We are still a large deficit of homes that still need to be built. And the housing market, I don't think, is as weak as what most people think. It's an affordability problem at this time. I understand it. And interest rates have rocketed higher. Interest rates are playing the game of holding it all down. They're holding this down. They're holding that down. They're trying to hold inflation down, trying to hold the real estate market down. They're holding inflation down through the real estate market. That's really what they're doing. And then what they're going to do is they're going to try to thread the needle with an interest rate that basically has a 2% inflation rate, whatever interest rate that is. And then they're going to try to hold it there. That's what they try to do. But no one's perfect. No one can thread the needle, so to speak. And then they overshoot, undershoot, overshoot, undershoot, and you get these boom bust cycles. That's basically the boom bust cycle of the business cycle. So that's them overshooting and undershooting interest rates instead of kind of holding them steady. It's also them creating money, not creating money, and overshooting and getting further and further away from a stable market. So when we look at this, and I look at URNM, I'm just using this as an example here. This was your inflationary kind of move from all that money printing. This is the disinflationary move here. And at some point, I think we are going to consolidate here and break on out. When looking at this herd, we usually draw trend lines where prices have turned. So that's all the turning prices. So that creates a trend line. I'm also using this where prices have turned for a support level. So you could say that we've got a strong support level. The stronger a support level, the more hits you have on a trend line. So you've got a whole bunch of hits down here. You've got a whole bunch of hits up here. And what's happening is we are consolidating into a corner at some point. What that means is that the buyers are equaling the sellers, and those buyers equaling the sellers will eventually determine which way this thing breaks. The way that this thing will break is dependent on the market conditions. So when you look at this and you look at this pattern, it's not about this going into a corner and saying, I don't know which way it's going to break. Let's wait for the breakout. Let's wait for this. Well, what we can do is gauge, well, what's going to happen? Are we going to have an inflationary environment or a deflationary environment? If you think there's going to be a deflationary environment, which there very well could be, we would break to the downside. If it's going to be an inflationary outcome, let's say there's a banking scare and they're going to print a bunch of money and it's going to be inflationary, it's going to break to the upside. Because what we've learned is that uranium and a lot of these other commodities do very well in an inflation or a rising inflationary environment versus these other types of market conditions like deflation or disinflation. So the question really is, what type of environment is it? Is it a increasing inflationary environment, or is it a deflationary collapse? Now, one person can view this, and we got that channel there, we're in it. One can say, well, I'm afraid of deflation. And then your question should be, well, how long does deflation really last? And how bad is the outcome? And how could I mitigate the risks of that deflation? So if we have a deflationary crash, and I don't think that's the case because we're not going to be destroying credit, it's liquidity driven, but I understand it could turn into something if we get like a run on the banks or something like that. Maybe there's some sort of outcome that I can't think of. But if this were to fall down, how far would it go? And what would be the max pain? Now, let's just say, it does pull back, and we can put the move here. Let's say we pull back and it pulls back to the 0.618 level-ish. That's about $25. So $25 from $29 is not that huge of a pullback. And even if we were to go a little bit further, maybe we hit $21. And I know that seems like a lot, but so let me pull out the calculator. I know I do this sometimes. And if we pull out the calculator, and let's say it's 29 minus 25 divided by 29, that's a 13.8% pullback. we've already pulled back from its high 50%, slightly under 50%. So one strategy that one could deploy is say, okay, we know there's uranium deficits out in the future. I am a long-term bull on uranium. So what could be one of the strategies that I could deploy if I think another inflationary wave is going to come behind this one, pushing and breaking this to the upside? Well, if that's the case, how about when a stock trades at around 50% or lower, I cost average in. So you hit this 50%, you cost average in, and if it dips down, I continue to cost average in all through here below that time frame. And then you'd get this entire area where you have a cost averaged position. Even if you add it up here or down here, that's okay. You're still getting a very good position, especially if you think we're going to go to 100 plus on URNM. So I don't really see, at least, I'm not talking about advice or anything like that, but I just don't see a huge problem if someone looks at this and starts to accumulate in a specific zone using a strategy. I usually call it sprinkling in. I sprinkle into my positions, I cost average in. A lot of people get really afraid, but guess what? That is when you make the money. You make the money when everyone is in fear. You make the money when you are cool as a cucumber. I don't know if that's a saying. I think it is. You're cool. You're steady. Your account may look, let's say your account is down and you're not feeling good about that emotionally. You're going to have to push those emotions. You're going to have to manage those emotions, control them. And you're going to have to come up with strategies to say, hey, you know what? I need to develop a new strategy. Something needs to change if I'm buying tops and they're always turning down and I'm getting underwater in my position. So one thing I do teach on the website and I look at it is, well, what strategies could we deploy? And what I'm doing is I'm looking for stuff that is down. Yes, it may take some time for it to work out, but I look for things that are down. And guess what? URNM is down off of its highs by 50%. Now, the general rule of thumb for a lot of these companies, a lot of ETFs get about 50%, some get down, but this is the range that a lot of companies pull back in, and they come back to this range. And that's the accumulation zone. So maybe rather than chasing and buying it because it's rocketing, maybe that's a bad strategy. We need to throw that, get that strategy out of here, right? Maybe we should wait for a pullback, wait for a consolidation, and then say, you know what, we're getting pretty close to what I think could be a pivot where they're going to start printing money. We also have this kind of looks like a head and shoulders type deal that's basically bottomed out too. So I bet you this is probably pretty close to a bottom. That's my guess. But sometimes, let's say you're nervous, you're a little less aggressive, well then wait and buy into strength. That is one of the least, I'll call it least risky ways to play the game. You let something fall the way back and then you buy into strength. But you could also you would have done that here, you would have done that here. You wait and you buy it and you buy it here, you wait and you buy it into strength. And sometimes, it still consolidates and pulls on back. Another thing that's really important is, guess what? No one is perfect. So what I do is I do this technical analysis with hurricane winds at my back. The market conditions is what I mean by hurricane winds. So I'm never trading against the flow of money or against the flow of things. What I do is I take a big long-term picture. I say this is going to be bullish for the next 10 years because of the market conditions that are set up and the underinvestment, the deficits that are out there in the future, and the credit expansion that's coming into the system with a certain demographic and the deficits in the housing market against that demographic. So if I take a big picture view and I think it's going to be inflationary, I just buy it, hold, and I hold the bull market. That's what these really good investors do. They don't trade in and out and try to get these little market moves. These market moves here, like this is a pretty big move. This is a pretty big move. I mean, that went from $35 down to $25. And it scares people. And if you're going to try to make a lot of money, you're going to have to get used to the volatility and the swings in the markets. So what I'm doing is I'm taking the big picture view saying that this thing's going to rocket higher. Someone's going to say, well, how do you know that that is going to go higher? How do you know that? And one, I don't know for sure. No one knows for sure. No one knows the future. No one knows what this is going to do. But Um, Generally speaking, if you can identify inflationary environments and what the drivers of those inflationary environments are, then you can say, okay, if the demographic coming into home buying years, and we have a shortage in the housing market, if that is strong, if that is where inflation is coming from, and that is exactly what the Federal Reserve is trying to do, is prevent those people from buying homes and expanding the credit system through interest rates and the affordability of housing, then we should bet with it until that trend stops. And that's all. That's basically what I do. I just bet on that trend existing until it ceases to exist. How do I know that trend is still existing? Well, we've got underbuilt homes by 3 to 6 million homes that we haven't built above average. We need to go above average to eat through that deficit. The average home building is about 1.3, 1.4 million a year. We haven't done that. We have the demographic there that wants to buy homes, can't buy homes because the affordability is bad and there's no inventory. So that's a problem. The cost to build new homes continues to increase through inflation. So it's going to be tough for a lot of these people to buy some of these homes and get in the market. So they're going to have to continue to save, and eventually they'll save up enough money to have a down payment. And depending on where interest rates are. So I think that looking forward, it's going to depend highly on interest rates. Because what we've seen, and I don't try to jump forward and I don't try to make guesses. I just look and see and evaluate and then refine the thesis and move forward. What we've seen is that when interest rates rocketed on higher, we hit a point where the housing market really slowed down. What's going to happen is the interest rates are going to stay high for probably a hair too long. And then the inflation rates are going to drop down. And when inflation drops down, which we're doing, it'll come to a level where they're like, okay, this is looking good. We're going to drop back down the interest rate. And then inflation is going to kick back up again because we've got the underlying strength of that demographic interacting with the housing market. And that's going to kick on the credit cycle again and a credit expansion phase from real estate. If the cycle was broken, then we would have that crash. And the way that you can tell that we would have that is a hyper supply phase in real estate. We would overbuild, have too many homes in inventory, and the prices would fall irrespective of interest rates. So even though interest rates would drop down, we would still fall in home prices because there's no demand for them. There's too much supply for the demand to soak up that supply. That's what happened in 2005, 6, 7, 8. We built too many homes, and there was a bunch of foreclosures that came out of the market at the same time, causing a gigantic oversupply, 12 plus months of inventory of homes. We are at 3 months of inventory right now. So what's happening is the market is trying to balance this all out. And we can see that in the charts. We have that disinflation kind of coming down. Now, why would I not sell out? Because I don't know what the future is. I don't know how far this will necessarily pull back. I didn't know where exactly this turning point would be. I know we've got the technical analysis. I know we've got all this stuff, but it's so much easier to not worry about all these little market movements and overstressing and over complicating the trade or the investment. Why don't I just stay long? Why don't I buy on dips? So basically, it's stay long, buy on dips in a bull market of commodities, and I'll buy the commodity stocks and or the commodities themselves. It makes it super easy. Now, another thing, there's things called fractals. Fractals are patterns that repeat over time. So it's the same pattern. Some of them are stretched out, some are squished up, some have larger up moves, some have smaller up moves. But the overall pattern, the way it scribes out, is the same over and over and over and over. This fractal here, in terms of URNM, this fractal that comes up, comes back, and then pulls back, this entire fractal is a leading pattern that we've seen in other commodity bull markets in equities, for commodity equities. So it possesses this fractal, the way that this has moved in the beginning of bull markets when we compare those fractals to other markets. Another thing that also is further evidence that we are in a bull market is that in the beginning of a bull market, what generally happens, and I've shown this before, I'm just kind of verbalizing for everybody. The stock market usually runs in a disinflationary environment, low inflation with low interest rates. Stocks love that type of environment. It also means that you've got low commodity prices. So there's an abundance of commodities, and the companies that turn commodities into usable products generally have the highest margins and highest valuations under a low inflation, low interest rate environment. That's when all the money prefers that sector. And then when the inflation kicks up from the housing market, that's when money rotates and moves and favors these types of investments like uranium, oil and gas, copper, nickel, so on and so forth, and precious metals. So there's certain sweet spots during the business cycle to be invested in, and then there's other spots that you don't want to be invested in during the business cycle. And that's really what we're playing here. It's one gigantic business cycle. I think that we are still in an expansionary phase of real estate. I think that inflation is going to come back. Is that debatable? Yes, it's debatable. That is not a proven fact. And I think that inflation is going to come from multiple areas. Inflation, the way that they measure it is from the consumer price index. The consumer price index has energy, house prices, and some other odds and ends, services and prices of things in it. The big drivers obviously are housing market, and we have a shortage of homes. And they're going to have to keep those interest rates up, and the home prices are going to remain, I think, elevated to going higher for a good while because of the demographic that is in home buying years. So that is going to be a persistent inflationary tailwind for real estate. Energy is also short. We are on short supply. We could potentially roll over in our shale oil, and there's going to be problems in a lot of different commodities based off of the supply and demand of those commodities. The supplies are pretty weak. We are depleting the world's commodities, and as we go up at an exponential pace, it becomes harder and harder to replace reserves from decline rates in those commodities. So as you go up, it's harder to go higher and higher in space, so to speak, because the decline rates are trying to drag you down of existing production in the world. That includes copper, includes anything, and oil and natural gas and whatever else. Technology is fighting that decline rate. It's fighting the moves that are coming down. So we can go up as long as technology becomes more efficient at getting this stuff out of the ground. But at some point, it becomes a flow rate problem, not a reserve problem. Flow rates is what really slows these things down because you're going after harder and harder to get oil, and you can't get it as easily out of the ground. That's why the flow rates slow down. So it becomes a flow rate problem when you have to yank enough out. And you also have energy return on energy invested and a whole bunch of other things. But I think it's going to be inflationary because of the difficulties of getting commodities out of the ground, whatever it is, and the credit expansion and the end of the debt cycle. The end of the debt cycle is basically we are going vertical in our debt, and more debt issued means that you've got more money in the system. But if there's not an accompanying GDP growth with that debt, it becomes inflationary. So it's a combination of all of those things. It's a problem on the supply side of commodities. It is a problem with the debt creation and expansion on the credit cycle side. And on top of it, we have a demographic coming into home buying years, at least in America. And remember, these commodities and all this stuff's priced in dollars, at least at this time. It's going to have a problem there because it's going to put pressures on inflation from the housing market and credit expansion. There's also another one where we kind of took advantage because we were the reserve currency in our system, and we could print this stuff and get commodities with the currencies that we created. When that currency isn't used to transact commodities, that currency wants to come back home and buy things, which will also be inflationary. So there is that tailwind that is increasing over time as well. But that's what we've got. I mean, that's it. There's a lot there, and I'm sure I'm not sharing absolutely everything, but that's what is behind the pattern. That is what's driving all this stuff, and I think it's beneficial to take a long-term approach, and it's beneficial to remain a bull, given that the market conditions look good. That's all it is. If you guys want to sign up for the website, check it out. It's a platinum membership. We talk about a lot of this stuff. You can ask me questions directly. Again, we've got a 7 a.m. Mountain Standard Time question and answer session on Saturday. And that's all I've got. If you guys like the content, give me a thumbs up, subscribe to the channel, and we'll catch you next time. This is Finding Value.